Hi everyone, and welcome to a brief market update. No doubt you've seen the doom and gloom and bloodbath headlines in the media. Let me tell you why I'm not worried and what we're doing with your investment portfolios. My views are based really on four main themes. Firstly, I believe the fear around inflation spikes is overdone and central banks will be cautious in tightening. Secondly, we are in a resources super cycle that is expected to see Australia's economy outperform global peers. Thirdly, the supply shocks due to COVID that have driven economic distortions over the last few years are expected to dissipate. And lastly, the energy shock is expected to start correcting as policymakers and energy providers shift their strategies away from reliance on Russia and move towards renewables. Last Friday, the US share market fell quite sharply and the Australian market followed on Tuesday on opening after the Queen's birthday long weekend. I'd like to cover why this happened. Basically, it came down to new data that was released showing that inflation in the US had risen again and would likely be with us for longer than expected. Share markets don't like high interest rates and have reacted accordingly. The two key components we use to work out the value of a company are the interest rate and the expected future profits. So we effectively get a valuation today that is lower than what we had previously had in our forecasts. This doesn't mean that these companies aren't going to be making profits in the future. It just means that those profits are worth a little less today with the highest interest rates, and the current share price reflects this. Now, I'm not sure that markets won't fall more from here, but my view is that we are much closer to the bottom and valuations look much cheaper than what they were several weeks ago or even months ago. The NASDAQ, that's the US tech index, is down over 35%. And the main US index is down over 22% from its peak. Now, these sorts of numbers may be scary, but are really considered to be quite healthy for the market and provides a good shake-up of valuations and can reset expectations. Now, some analysts would have you believe that a recession in the US is a certainty, but my view based on the data we have currently is that I don't think it's likely that the US central bank will lift interest rates to a point that it causes a recession, although the markets have reacted as if this is all but a certainty. In Australia, we have seen around 13% correction in the share market since its high in April, and I still consider this a healthy aspect and shakeout. We have a very different composition in our market, with over 50% made up from effectively resource companies and banks. Resource prices have held up very well, and our banks have also held up very well in comparison to other banks around the world. The risk for the local banks is that earnings will reduce as people start to default on their mortgages due to higher costs of living and interest rates. So bank shares could fall much lower, but that's not my current view. The market has forecasted that interest rates will peak around 2.5% next year. I think that could edge a little bit higher for a short period of time, maybe up to 3%, but I really see that as the top end. I'm also confident that the Australian Reserve Bank will be able to revert interest rates to neutral positions without causing a recession here in Australia. We must remember that we went through a period where we had interest rates set to emergency levels, close to 0%. We can take that emergency setting off now. Australia's starting position relative to the rest of the world is quite favourable, with resilient growth, company profits, lower inflation levels, a strong labour market, high savings rates, a stable banking system, and I feel we can handle interest rates back at normal levels. As China reopens and stimulates its economy, that should also be good for our resource sector. At current levels, my view is the Australian share market offers good value. I think there is a lot of bad news already priced into the numbers, and I don't believe this is a time to panic. This is a time to let your portfolio do what it's supposed to do. I look forward to updating you in more detail over the next few weeks in July as we complete our quarterly reviews. In the meantime, please feel free to contact me with any specific questions. Thanks for listening.